The third quarter of 2024 ended with healthy returns across most major asset classes, despite several significant bouts of market volatility. Amongst other things, we witnessed the Japanese yen's strongest run since the 2008 global crash. We also saw central banks swivelling at speed. We saw oil diving and gold simultaneously shining within a geopolitically charged environment, and China unleashing significant economic stimulus. The storms began when the normally well-behaved yen went certifiably wild in late July at the idea of higher Japanese rates and a potential unwinding of the yen carry trade. This happened at almost exactly the same time that US economic data started looking a bit softer. Despite this, global equities had another strong quarter, overcoming a bout of significant turbulence and showing remarkable resilience. Concern around economic uncertainty, compounded by the aforementioned surprise hawkish move by the Bank of Japan, led the VIX volatility index to spike and touch its highest level since March 2020, when concerns around COVID were at their peak, as shown in this chart. However, sentiment improved as the quarter progressed, helped by various central banks' dovish pivots, including the US Federal Reserve's decision to cut rates by 50 basis points, and the Bank of Japan's subsequent indication that any further tightening would depend on financial stability. US economic data also proved to be more resilient than feared, helping global equities rise for a fourth straight quarter. Meanwhile, China unveiled its most substantial stimulus package since the pandemic to boost its own ailing economy, and this helped the country's equity market to recover and post its best quarterly performance since 2009. European and UK equities also advanced, albeit by a smaller magnitude. Australian equities surged, even as economic growth slowed, and Innova has become increasingly cautious regarding the valuation of Australian equities relative to their earnings prospects. Japanese equities, however, were the main exception to this rising tide in markets, as despite a circa 20% fall and then subsequent whipsaw rally, they still finished slightly behind for a second quarter following the BOJ's rate hike. Looking at market leadership, Q3 saw a noticeable rotation away from tech stocks, which Innova has been underweight to for some time. Real estate and utilities were the top performing sectors within the MSCI All Country World Index, while industrials and financials also outperformed. By contrast, IT and communication services lagged after some disappointing earnings numbers called into question the elevated valuations being ascribed to these businesses. Energy was the weakest performer amid sluggish economic growth outlooks. Notably, the equal-weighted S&P 500 index, which removes the imbalance of the heavily weighted mega-cap tech stocks, outperformed the market cap-weighted S&P 500 index, signalling a broadening of the rally. The small-cap Russell 2000 index comfortably outperformed its larger peers in anticipation of lower interest rates ahead. Innova maintained exposures to both these themes via the QUS and QSmall ETFs. Fixed income markets were also buoyed by falling inflation and the prospect of lower rates, with government bonds and credit both delivering solid returns, and we continue to maintain low-risk, diversified exposures in these areas. My colleague Shane Wang will elaborate on our positioning and the outlook going forward in the fourth quarter.